All right, so thank you guys so much for your patience. We are going to begin. Right, so just to bring us together, sorry, thanks again for your patience. Sorry for the late start today. We are having, today our presentation is pretty much going to be wrapping up of everything that we started with on the 1st of November. So we want to today complete our interrogation of the financial vehicle process. And we're going to speak today with Wayna Parchment. She's going to give us a good idea of how to, when you're contemplating financial planning, how to do so in a way that minimizes taxes and minimizes fees. Right, and we're going to finish up on our presentation that we didn't quite get to complete on the 11th of November, which was on businesses and how do you create wealth through businesses. And then we'll look at estate planning and just kind of put that together to give you an idea of what an estate plan looks like, what are the considerations when you're contemplating them, and just some tips as well when you're getting ready to sit down and develop your estate plan. Yeah, thank you, Robert. Yes, I do believe it's recording. Yeah. Here we go. Yeah, so we are recording. Thank you for that reminder. Okay, I'm going to go ahead and share my screen and let Natalie just begin. Here we go. Let's just jump to the beginning. All right. I'm just trying to jump over a second. I just saw some people join and I just want to admit them.
All right, so last week we actually was telling you, we were informing you on how to do the trust accounts and the different trust accounts and how you can how it can help you create your generational wealth. Now this is just a recap. You have the trust account. You know how to create select your trustee. That is something that you need to think hard and long about. The guarantors, that's a person who is going to put the asset into the trust account, and then you have the beneficiaries who are the ones that benefit from it. The trust accounts were based on you wanting spaces to put your investments, or you wanting space to secure generational wealth. So that was what we covered last week. All right, and we have Wayna, who will be presenting today. She will provide you with the information on certain scenarios on how you can grow your wealth.
Okay, just 1 minute. All right. Okay, so Wayna is going to go ahead and present now. I'm going to flip over to her presentation so we can see.
Hang on, let me see what the one Kaiba. Hang on.
I'm going to share it. Yeah. Here.
She has an advocate.
Go ahead, introduce yourself first.
Welcome everyone to this segment. My name is Wayna Parchment. I'm a certified financial planner, a division leader with Primerica Financial Services, and I've been serving our community for the past 20 years. So today it's about financial planning, but I have some TIM cards I want to give you, but you'll have to work for it. So any participants, so you could text, you could say it on the chat, you could, are you able to unmute?
Yeah,
They can unmute and say the answer. So you're all in for a game. So according to the Canadian stat, what is the average debt load Canadians are carrying, not including their mortgages? 15,000, 21,000, 30,000, 46,000.
And just to clarify, you mean currently, like at this moment, and not over our lifetime? Okay.
No, right now.
And does that include more? Oh, not including mortgages. Okay.
Mhm.
So Dwayne,
C.
Who's responding?
Cheryl.
Cheryl.
Cheryl says C. Dwayne, did you change your answer?
Oh, it's D, 46, yeah.
Dwayne says D.
No, none of the answers so far.
Not C or D?
No.
Okay.
A.
Oh, now we're just guessing.
Dwayne, you had the answer first.
We changed it.
You change it.
Okay, so we can just assume it's B now
So
because
it's
it's
B,
21,000.
21,000.
Yes.
All right. So Dwayne, I'm going to give it to you because you have the answer first. So we're going to get your email contact and then we'll send that out.
Okay.
Awesome.
The next question is, what percentage of your income should you save in order to be financially independent in the current situation we are? Not what they used to say.
Oh, I'm thinking, yeah. I'm playing too, so I'm thinking 10%.
Oh, you're playing too.
I'm in the game.
There's
I'm
no-
gonna say C.
C, Cheryl, that Cheryl said C.
Yes.
Any other takers? B, 10%. Okay, so it's between 15 to 20%. So we have Cheryl. Cheryl is the winner in this one. Okay. You know, cost of living is high. The chance to even get a house, right? So the next one, the last question. So if you haven't got anything yet, you got to get into this.
So Cheryl got number 2.
Yeah.
Okay.
So what percent of Canadian families with dependents have never purchased life insurance?
Okay.
B.
Cheryl says B.
30%. Anybody else?
I say A.
A. Who's saying A again? That's Robert.
I think that's Dwayne.
Perfect. Robert, perfect.
No, that was Dwayne.
Oh, no, I saw A. Who said hey?
Oh, somebody put okay.
I saw Robert.
Oh,
And then Conroy said A too.
well, it's too late.
That's okay. We give both of you. Because this is sad because 49% of people with dependents, that's like 1 out of 2, do not have life insurance.
Okay.
So who's going to take care of those kids, right?
Yeah.
All right. So this is just an awareness. So based on the feedback that we get and the questions you have, we produced 2 case studies. So case study, let's meet Miss Mary Brown, age 28, with an income of 45,000. So maybe she just get her first professional job, right? So for her, she want to know, what would I do for savings for retirement? So with 45,000 income, she has a current income of 3,750. When we retire, 30% goes back into working. So we would need around 70% of our actual income. So our actual income that she would need would be 2625. But remember, she's 28. So fast forward 65, when she's 65, 37 years now, that she would have to have 7,900 to purchase the same thing today with
Mhm.
26,
Wow.
25.
Right.
See that, you see that changes in inflation?
Yeah.
That's like almost
That's
3
deep.
times.
Exactly. So look at now, so, but she would also love, to leave some money for her family.
Yeah.
Good girl, right? So we assume that she may die at age 66. Inflation 3%, good news. We think the interest rate is going to go down because we all need that.
Yeah.
And it's investment. She's young. We could take on a little bit more risk with her portfolio. So at 8%, if she get that minimum in retirement, but after retirement, guess what? We got to be more conservative,
Yeah.
right?
Mhm.
So what would her number look like? How much money would she have to save in order to achieve at age 65? So that's called your financial independence number. Always know your FIN number. So her FIN number is $1,459,409.
So the FIN number is the goal that she needs to save by the time she hits retirement.
Exactly. And it's a good thing for you to go through life knowing that I have to meet this number, right?
Yeah.
A lot of people don't have this, right? So, but now we have the FIN number. How much she need to put aside? She would need to put 534 a month to achieve her goal. So that's paying yourself like $250 or so every 2 weeks, right? So that's her FIN number.
Now her income was 3,700 per month, and she'd have to find room for that 500 to come out. So, yeah, it's hard.
It's achievable if you're home.
Achievable.
If you're
Yeah.
home, when I have like when I have young adults at home, I take out $1,000 and they can do it 500 bi-weekly, right? Okay.
So that's Mary Brown.
Yeah. So also life insurance need, she should have at least 500,000 in life insurance coverage. If anything should happen to her and she really want to leave something for her family, right?
Now she's 28 years old too, so that's what you recommend would be ideal.
Ideal.
Should
Because
she start at that age?
yes, and the thing about it, the insurance regulators are very high. For you to give her $1 million, you have to prove why she need $1 million.
Yeah.
She doesn't have any dependents, so they're very high on regulator. Sometimes we could say, if she's going to buy a home within a certain time,
Right.
then we could have the cost of the mortgage,
Got you.
right? And then you want her to focus more on saving. You don't want her to focus too much in insurance. But sometimes the question is, why do young people need life insurance and they don't have dependents? So, young people will say, I don't need life insurance. But we want to make awareness. You're locking insurability, especially if there's a genetic medical condition, like there's cancer in your family, dementia. All of those are important.
Taken in consideration.
And also, you could get severely injured or develop unforeseen medical conditions. You hear so many young people with breast cancer, right? Also, the advantage, you're young and it's affordable. But a nice feature that most life insurance company policy has, if you're diagnosed with a terminal illness, the insurance company will advance you up to 40% of your insurance coverage, which some people have used this and are still alive.
Yeah, that's what I'm reading here.
Yeah, a lot of people don't know that, right? So you would have access to at least 200,000. You could take it, go some other place where you could get more coverage, or you could do what you wish, your lifestyle.
I
right?
did not know that.
So that's a provider.
So this is in addition to a life insurance policy itself, or is it just
A
something you
feature.
would?
It is a feature. A lot of people don't know that's a feature. Why you should have life insurance? Because picture a young lady like Mary Brown. She got sick at age 35. She don't even have 200,000 in medical coverage or whatever. But if the doctor say you're terminally ill, she could advance that. She could say, let me try alternative.
Yeah.
Right? So that's a feature that life insurance has.
Oh, first.
Right?
Okay, but it's specifically with terminal illnesses.
terminal illnesses. Oh, you see that every year. I've heard people
right.
terminally ill.
Yeah.
Yeah, believe it or not, it does happen. Right, and mostly to leave a legacy, to enhance the family, not to leave debts behind. Right, because bad enough they have to come up with your funeral expenses,
Right.
and then they have to go with your debt.
So a question does arise for me, and anybody else is free to kind of chime in now to make this a little bit more interactive, because it comes up as I'm going. These are
Good.
things that I did not
Mm-hmm.
know at all.
Mhm.
So a question comes up as to a 28-year-old now seeking life insurance. Is it easier to get life insurance then, or a good life insurance policy when you're younger? Is it, what do the insurance companies question, like you're saying, why such a young person would want to have life insurance?
No, it's the amount you give them.
Okay.
Mhm.
But when you're younger, you are more easy to qualify for life
Mhm.
insurance.
So that's very interesting.
Mhm.
Okay, it's like sometimes like the situation where you can qualify for to purchase a house because you have the deposit, but your credit is not good enough, so you can't get the best rate. But in this instance, you're younger, so we're more likely to give you you're more likely to
Better.
qualify for it, but the amount that you can, okay.
So like a 50-year-old will versus a 28-year-old will be like 2 or 3 times the amount they would pay.
Right, I got you. Okay, so it's good, you can get a good
Yeah, you
affordable
can
life
start-
insurance plan.
Yeah, at a reasonable.
And you have
price.
your
The price
financial
is-
planner, so you go back to her a little bit later
Oh,
when your
yes.
situation, okay.
The thing will change. And now if Mary Brown start make 90,000, guess what? Her plan will be changing, right?
Yeah,
So
okay.
she can put more into a plan, right?
Yeah.
And now she wouldn't be living at a 45,000 income. She'll be living at a 90,000 income. Now she has a Bentley, you know what I mean?
Or Bentley. Got you.
Okay.
She's living that lifestyle.
Right. So in summary, you may have the greatest plan, but if you don't implement it, it's no plan,
Yeah.
right? So she should implement a monthly plan first for an emergency fund
Yeah.
in case of loss of job, especially. So she should put 409 towards her emergency fund.
Yeah.
For $40 or less, she could put in a life insurance. The retirement, the program is 534. So she may not have this at the same time, but the first thing I would go is the emergency fund, then the retirement.
Okay.
So clients may come to you and say, I want retirement plan,
Mhm.
but where's your emergency fund?
Yes.
And we see what happened in COVID, right?
Yeah.
People
Yeah.
didn't
So
have.
like you would have different emergency funds account like that you would set up for her. Is
Yeah.
that correct? Like, so say for example, she wants to put it into a high interest account or something like that. You will find out her I guess her threshold when it comes on to taking risk and decide on what plan
We
to
would
put her
put it
into.
in it, yeah.
So
But-
could that mean that that amount of 409 can also change based on the risk that she takes?
Yeah, if she's gonna be in a high risk where she could make more,
Yeah,
then it would be, she could put in less. And the same thing with retirement. If
Yeah.
you can get like a 10%
uh-huh.
on your retirement, then the amount would less,
Yeah.
right? So when we meet with people, they may not have 534.
Right.
Yeah.
But we could say, okay, based on the fact you only have 300, we will take on a little bit more
Oh,
risk,
got you.
right? So
got you.
it's the whole idea of working with a financial planner. And every 6 months, you meet with your planner to say, here, this is what's happening, how we're doing.
Okay,
Right.
got you.
Okay, so this is my favorite girl. Age group.
She's the ideal, she's the one, we're coming to you in droves when we reach this 55 year.
Exactly.
Yeah.
So she has 10 years for retirement at age 65, right? And her income is 75,000 so far. So based on 70% of her income, if she want to live on that, that would be living on 4,375.
Mhm.
But 10 years from now, it would be 5,900 to have that same purchasing power of the
That's
4,000.
4,000.
Yeah.
So we got the same, right?
Yes.
And she would like to leave some money for her family.
Mhm.
So life expectancy is the same, but she has some money. She's been around, right? So we hope she has some money. So she has about 350,000, right?
Yeah.
So let's see what her program will be.
Okay.
So she will need to have, say, 946,000, 946,547.
That's her FIN number.
That's her FIN number. Yeah, I
Mhm.
love it. The FIN number, right? So the
Yes.
next 10 years, Michelle is like, I need to have 546. But Michelle would have to pay $1,000.
946.
Yeah, but she would have to put $1,000 and $1,020 a month to
Per
achieve that
month.
goal.
Oh.
Because right now, as we see, we can't put Michelle in too much risk.
Mm-mm.
Right, she's too close. to
Yeah.
Yeah, right. So we have to put her in, just for her, she would even better to put in more than
Right.
us at this
Right,
point.
right.
So this kind of help you guys to see how important it is to have
Start planning
a
early.
planning, right? And sometimes like for me, the kids are older, you could free up money at time,
Mhm.
and
Once
let
you-
them pay rent too. Why not? Because I said to my son, I want you to buy a house and I come and live in your basement and it's called reverse parenting. All right. So for life insurance need, does she really need life insurance?
Mhm.
She could be yes or no, to be honest. But take care of funeral expenses and if she pay off debts. However, if she has a mortgage, this may be more than 500,000.
Right, especially today, yes.
Exactly. But if 55, she probably have her house 20 years ago. So she
Yeah.
probably have a very
Asset
low
in there,
mortgage. And there's
yeah.
lots of equity.
Some
too.
equity, yeah.
Yeah.
Okay.
But mostly we always want to leave a legacy for our family.
Yeah.
I have a question that's coming up to me,
Mhm.
right? Because there's so many different types of insurance. And in this instance, I'm thinking about mortgage insurance.
Mhm.
Is this something that you can speak to? Like at Michelle's age, would it be more beneficial for her to obtain mortgage insurance to make sure her mortgage is paid off, for example, rather than a life insurance? Because I'm imagining a life insurance would cover more than whatever debt she has on the house.
Well, to be honest, in Canada, I think no mortgage company, no banks are going to take you on without you having mortgage.
No, they let you
insurance and
feel
insurance.
like, but it's not mandatory. The only
Right, yeah.
insurance that's mandatory is property.
Property.
Mhm.
We recommend
yes,
that she has
parent insurance, yes.
insurance on herself,
Okay.
not on the mortgage. Because what happened when you start your mortgage with 500,000, and now your mortgage is 250,000. They pay off the mortgage. What happens to the other
That's what I'm
250?
wondering.
But if she has 500,000, her
Right.
dependents get, and sometimes these kids probably don't even want the same house.
Now, the thing about what you just did here is you say that the mortgage company, because I want to touch on that. The
Mhm.
mortgage company does, when they're giving you a loan, put insurance on the
That's an
mortgage.
option, yeah.
And I mean, I don't know if anybody else techie, but I gravitate to those kind of insurance because I know that they have something worth holding on to. You know what I'm saying? The
It's for
property
them.
yeah, so
It's
they're
in their
protecting
benefit.
They
them.
have to be
Yeah, they're
named as
protecting
the
them, but at the
beneficiary.
same time, it's also protecting me because I'm paying into this. So I know that this mortgage will be covered if just in case I pass it, or it
Yeah.
doesn't work like that.
Yeah, that's fine, but it's only the mortgage payment.
Right. So this was my consideration as well. When we went to get our mortgage, I asked right away, is this optional?
Mhm.
Because I do want to know what I'm paying into and what I'm going to get. And this is why I'm asking you the question,
Great.
because it occurred to me that all I'm paying into is for the coverage of whatever debt is remaining on my property when I die. But if I was to use the same amount or a little bit more to put towards a life insurance, I'll get more
Exactly.
return at the end that would pay off the mortgage and that would leave some for my beneficiaries.
Good.
And remember too, the bank is just covering them, the mortgage company is covering themselves. Because unless you bought a property that was, you paid 20% down. But if you buy less than 20%, you pay CMHC. What is CMHC supposed to do? If you default, if you die, they're supposed to pay that.
To the bank.
So you double, the double insure you to pay for that debt.
It depends though. Again, it depends because some people do not go through CMHC for their mortgage.
Yeah, if they don't need
They don't need
CMHC.
CMHC, they don't go through that.
Mm.
But I understand where you're coming from, to be honest. I do, because however,
Majority of
peace
first
mind,
mortgages
yeah,
are insured by CMHC.
CMHC.
Majority.
So
Majority.
if I default,
Mhm.
oh, but wait,
You see?
I did not consider that. No, my whole thing was, I saw it there and we paid the fee, but it did not occur to me that it was some type of a mortgage payment insurance in that
Yeah.
way.
Yeah.
That's how the banks will afford the risk because CMHC is gonna offset
It's covering it.
Yeah.
Okay, good to know.
So they double, you're paying them double.
I love it. Like that clarification.
Yeah. So in summary,
But
she.
I want you to know though, CMHC doesn't last forever. Like, say for example, you get a mortgage and you use CMHC.
Mm,
When you're up for renewal, you can stop using CMHC.
To insure.
You can come up, like, it's a program. I'm just saying, like, yeah.
That's another
from my
conversation.
experience. Yes, that's another,
Yeah,
sorry.
that's an option.
Explore CMA.
Yeah, that's an
Board,
option. Looks
yeah.
like that's a big.
Yeah.
Yeah,
All right. So as we say, a plan is only a plan when you implement it. So
Yeah.
for her, 1,020 life insurance, between a term and a permanent, it would cost her about 200 to 600.
$600.
Right? You see, $40. What the
Yeah,
other
Yes.
when you're younger.
Yeah, and now it's really
Yeah.
high.
Yeah.
Question before we go ahead. I saw in Michelle's case study that you had also put inclusive of retirement benefits.
Yeah,
with it? So like, so that's
CPP
Right.
and old age security.
yes,
Yeah.
okay.
So we're fortunate in Canada to have fairly good
Mhm.
government programs, and we expect them to last because they're well managed.
We want them
Yes,
to
I've
last.
been seeing that they are one of the best managed
Mhm.
public funds in the whole world.
Yeah.
Not just our hemisphere, so we're
CPP,
doing
yeah.
well.
Yeah, and they do good investment. We have
Mhm.
we know of companies we can't say that manage our money, so we feel confident because they also manage our money.
Yeah.
Got you.
Yeah.
Okay, so most people don't plan to fail. We just fail to plan.
Mm.
And this is
I
like hearing
agree
your
with
grandma
that.
saying this, right?
Mhm.
So what's the solution? A complementary financial needs analysis. So you're on this call, we offer a complimentary, confidential, customized program that help you achieve your goals and dreams. Maybe you had a plan years ago. We can always look at it again, right? So what would it provide? Solutions for debt management,
Yes.
credit management, savings for goals and dreams, income protection. I am very big because there's not enough life insurance in our community, and I cannot fund enough GoFundMe. I'm only one person, right? And income management,
Yeah.
right?
Yeah,
So
it sounds like GoFundMe is very reactionary because
Yeah.
you find that you don't have
Yeah,
savings
most
and
people
that
don't plan to
insurance.
fail.
Right.
They fail to plan.
There we go.
Yeah.
Exactly, right? So thank you so much for your time. I really appreciate this opportunity. You can always contact me any questions, and if you want a complimentary financial plan, I am always here.
Yeah, we'll let you have Wayna's information.
Once more.
Yeah, I'll definitely put it up at the end of our presentation. But I did have some very pointed questions, and I Natalie, did you wanted to ask, or should I jump ahead?
Jump ahead.
Jump ahead. I'll jump in. I have some very pointed questions, and I find them now extremely relevant because I'm now listening to you and finding out that I knew maybe like 10% of what really goes on in your considerations when you're making a financial plan. When you do get to a point to decide to make a financial plan, I'm considering, for example, from our end, we're considering estate planning. So what becomes a part of an estate plan? What should we plan to leave out of the estate plan? And whenever we consider estate plans, we're really considering tax savings. And we're considering savings on fees, for example. You have to balance the probate fees and the length of time to administer an estate, for example. So I'm all for a will, but I want to be all for a will where it's appropriate, where it fits the situation. Insurance is one of those products that fall outside of your estate.
Right.
how is that handled tax-wise? If I'm a beneficiary of an investment plan, is that considered income, capital gains? Do I have to declare it? Am I going to be taxed?
No, so if you're a beneficiary, most time the taxation will go to the deceased, right? So if she left and the thing with life insurance, there's no taxation when you get a life insurance, no. But if Mrs. Brown had 10,000 in stock and she gave you the 10,000, believe it or not, they give you all the 10,000, and the person with the estate would have to be the one who will look after those taxes.
The taxes.
So that's why the executive have to be very careful with distribution,
Right.
because they could distribute this money out, and what happened?
The estate is indebted.
Exactly.
And that's
Okay.
when the trustee becomes
Because
liable.
is in this instance, it feels like it's a question of a transfer of assets.
Mhm.
So when I pass away, and a part of my estate, for example, are securities and bonds,
Mhm.
I now have to transfer these, or my estate will have to transfer these to the beneficiary. And
Automatic.
at that point now, it triggers the transfer tax.
Tax.
Or
because
transfer
it's
to
an
the
asset.
estate.
Well, it's upon death, it's transferred to
to
the
the
estate.
estate.
No,
It's
if
now
it's as a
when,
beneficiary,
Yeah.
it's gonna go,
Right.
it's belong to the
goes
Eventually,
right
beneficiary.
through to, right. So upon death, it falls into the estate, you know, there's a will. Then, of course, the administrator now, or the executor now, would deal with the administration portion. And it's at the point of administration that all of these taxes would come up.
Exactly.
Okay, but an insurance now falls outside of the estate, and it's not taxable
Right.
at all, right? As an
It's
asset.
tax-free.
So this is an asset that I am paying. It's an asset. It's essentially an insurance is an asset, and it's an asset that I'm paying into monthly. That is tax-free upon transfer. I don't want to even use the word transfer,
No,
but
benefit.
upon the
It
beneficiary.
bypass all probates and go directly to the beneficiary.
Right, and so this, of course, brings us to the question of trusts. Now, if I was to have a part of my financial plan, a trust, how would I want to maneuver or direct the administration, the management of that trust to avoid as much taxation as possible?
So the thing with
Thanks for that clarification. Yeah, and that is a very good clarification, Robert, because based on our previous discussion about assets and liabilities, it definitely does not generate you any income at all. The insurance, so it's not an asset.
Yeah, that's
Thank you
fine,
for the
that's fine.
correction.
Yeah, that's fine.
Yeah.
Yeah. So the question was,
The trust, like, I'm considering what I would put in a trust. How would I manage it? What are the directions that I might give for management to my trustee to minimize as much as possible the amount of tax?
So initially, when you put something in the trust, you're trying to like freeze it. So that is the gain. But remember, any income earned in the trust will be taxable, unless it's like capital gain, which can be
Distributed.
You don't really get a capital gain until you sell, right? So the assets will be, the trust does make it more that you can split income, right? But once a debt and the trust is dissolved, and it doesn't have to dissolve right away, it could last, like a couple more years and so. But it's whatever income is in there is likely to create.
To be taxable. Unless it's a specific instrument that's tax-free, like a TFSA or an RESP, for example. Okay, and then
It's funny.
so then that means to me that it would be more beneficial for me to create a TFSA and perhaps put a lot more of my stocks and my bonds and so on in that TFSA. So like this is the strategic way my mind is thinking, how to keep the government out of my pocket.
Okay.
So I would just be very mindful of the products that I would put in a trust.
Exactly.
Knowing that should it gain income, it becomes taxable, and it becomes taxable the highest marginal rate as long as I leave it in that trust or at whatever my beneficiaries' rates are. Should I distribute that income before the tax year is over? But even more than that, I can have a TFSA.
Yeah,
I
we
can
had,
use
But
that
you
money
gotta
towards.
remember with TSFA, and this is something because we're doing this that I realize, there's a limit too.
Right, so there's always a
There
limit.
is going to be a limit of how much
but
how
you should
much you
max it
can
out.
keep in
Yes,
But
and
not
that,
fun.
that limit will increase, and
Every
it's
year.
every year it cycles
No,
over.
so
yeah.
what happened is, for example, you will get a room of, I think it's 6,000 something
Every
per
year.
Every year,
year.
5,500.
Yeah, something
currently.
like that, and and then it goes up to 88. You can take up to 88,000 from your TFSA, but you understand me, but the figure is not over 100,000.
Apparently,
From
it's
my
gone to
understanding.
7, it'll go up in 2024 to 7,000.
So it's going up
Oh,
So it
okay.
is something that continues to increase
every year.
every single year, the room that you're allowed, and you keep cycling
But
over
you cannot,
every
so what I'm
year
saying is,
as well. So if you don't
the
use it this
government
year,
will,
you'll have
the
it next
government
year.
will pardon you up to 88,000 right now if you want to take all that money out of your TSFA.
Tax-free, yeah, that, up to that
And
limit.
yeah, so that's what is tax-free from my understanding.
No,
So
what you
Robert, if
have-
you know better than that.
You
please
have
let
up
me
to
know.
the limit, so like
Right.
from when it opened to there, you have this accumulated limit.
Right.
You can take it out and put it back,
Mm-hmm.
right? So, but we always say maximize tax shelters.
Yeah,
Right?
I think that's what
Maximize
I'm
those.
thinking.
So not everything is that you want to put stuff that you're trying to prevent creating a taxable event.
Right,
Okay.
exactly.
Sorry.
That's
I'll do
what,
it now.
that's what I imagine
Yeah.
is the
Who is in the
consideration when
room?
I'm sitting, when I'm sitting, oh, I don't.
They're calling because they can't get in.
Okay.
Oh, here we go. I'm just seeing, I apologize, just seeing. Hi, Monique.
Sorry, so sorry about that. All right, so.
Okay. So thank you very much for that, Wayna. If any other questions arise, guys, please do feel free to send a message in the chat. Email as well as there. Reach out to us on Facebook and on Instagram as well. And we'll address a lot of those questions. So I think just to conclude, Wayna's point, it's really, if you sit down with a financial planner, you let them know what your goals are, your plans are for future and towards retirement. Like me, I want to travel all over the place. So I know I'm going to need a savings account for travel, for example, and then there's all these other considerations that come into mind. Like I want to lower the amount of taxes that I pay out and so on. So she'll talk to me about what type of accounts I might need to establish, how I need to manage those, how much insurance I need, for example. And this new one that you mentioned, what was it for emergency fund? One of these days it's gonna rain. Okay, so thank you for that. I just want to now share my screen again and move into business, which we keep running out of time for. I'm not too sure why. Okay, so let's go over to that. All right. Okay, so I just want to talk quickly about businesses as a means of wealth creation. In our seminar on the 11th, we quickly looked over some of the statistics, which talks about Black business ownerships across Canada. And we really sit in the lowest percentage of Black business owners, but of recent time, a lot of the agencies, government agencies and banks and financial institutions have come to realize that there is a huge asset in Black people owning businesses. We do tend to be a lot more innovative. We do tend to weather the storm a lot better than other businesses because I think we are accustomed to working under more difficult circumstances. So there is a tendency for Black businesses to be actually worth any risk investing in. So the government has responded recently with a lot more grants, a lot more programs. We see TDRBC developing specific programs and resources for Black business owners and for visible minority owners in Canada. So quickly, I believe the first thing that you do when you're considering opening a business is to have a business plan. Your business plan is going to be your skeleton. It's going to be the framework of exactly how it is that you want to structure your business, what it is that you want to sell, what are your product offerings, who is your market, how much capital do you need to start your business for it to be successful into year 2 and 3, because those would be the hardest years, 2 to 3.
Anika, I have a question. I wonder how much of our people, just like Wayna just did, how much of our people on this call have ever tried to open a business? That would be.
That's a
I'd
good
love to
one.
see. Can we see somebody raise their hand? Let's see how many of us have ever tried to open a business, and what was the hurdle that you experienced while opening it? Or did you try to, and then because you thought, maybe I have to get a license to do this, or I have to do that, you just couldn't bother with it?
Okay, that's a good question. Any business owners, once upon a time business owners, considering aspiring
business
business
owners.
owners?
Nobody
Someone send a
say.
message.
I did and
What does it say?
I did and just don't bother.
And just didn't bother.
Yes, say.
Do you classify real estate? Absolutely. So now that's going to be my next slide. Absolutely, Robert, I do classify
Yes.
real estate as a self-employed sole proprietor business. You have to do your own taxes. You
Yeah.
have to, you have to organize your whole entire business, your marketing, everything.
Absolutely, that has to be a business. Not because we as Black people do not think about it. I think that's a thing. As our generations is starting to get into the real estate realm of it.
Yeah.
But my parents never thought of that. My parents never thought
That's
that
true.
real estate
Would
was
be
an
self-employed.
asset to have, because I mean you can change it, you can move your real estate to trust too, trust account and stuff like that. So yes, Robert, like
No,
yeah,
as a realtor,
it has to be.
as a
Yeah,
realtor,
Financial
yeah.
planners.
it is.
Exactly.
Yeah,
All right, excellent. So, so this is my thing now. With a business plan, it shows you all of the moving parts that you ought to consider in your business. And I think with your business plan, you'll now know what type of business ownership is beneficial to you. And we talk about sole proprietorship. People who are financial planners, people who are lawyers, people who are realtors are sole proprietors. Right? The only distinction is you're operating the business perhaps in your name, so there is no need for registration. There's only a need to register a sole proprietorship if you're operating in a name other than your own.
Examples of sole proprietors are contractors. Some people, they register their business. They are you have contractors as sole proprietor, flower shop owners are sole proprietor. Those when you're a sole proprietor, you do not have that big it's all the legal aspects of it will become to the individual. That's what the legal aspect is. It's not going to be on a corporation. For a corporation, you have it stretched out, you have different bodies there to cushion it. But on a sole proprietor, the legal aspect is a bit different.
So yeah, so with the sole proprietor, I think we're talking about liability,
Yes,
right? So they do tend to be single business owners. Majority of small businesses are sole proprietorships, small businesses, right? So I'll correct myself when we get to corporation. And the liability, of course, is unlimited. So you are solely liable for the debts in the business, for any type of damage or loss to any clients, for example, anybody that suffers as a result of your business, you are directly liable. And it does tend to be self-capitalized, and most self-employed persons are sole proprietors. The next type of business ownership is partnership, which is normally 2 or more co-owners. The one that come to mind are probably law firms. Those are big partnerships, but there's many other businesses that do operate as partnerships. Partners split responsibilities and management, and they're either general or limited partnerships. The general partner is normally the one that's subjected to the unlimited liability. So there's still unlimited liability in this type of business ownership. We'll move on to the corporation, which is it's a type of business where there is limited liability. That is to say, the corporation operates as an entity in and of itself, separate from the directors and the shareholders, and they do not hold liability, and any liability that they hold, is limited, and it's limited in their articles of incorporation. That also includes debt. So the directors are not liable for debt. The directors are not liable to any type of damage or lawsuits that's brought against the corporation. It can be self-capitalized. I have self-employed here, but I also wanted to put that what's really great with a corporation is that you can definitely be the CEO, you can be the owner and be an employee on your own terms, right? So when it comes to like tax liability, for example, you're liable only for the income that you receive versus with a sole proprietorship, which it's like you're liable for the taxation of the whole business and the business operation. With a cooperative, we know cooperative associations, they tend to be owned by their members and the members exercise full control. It has a specific purpose and it offers various investment options. Most cooperatives that we tend to know are like farmers associations, building co-ops, right, that have a similar purpose with their members. Members join and they normally pay a fee. They normally pay a fee for their membership and they create a board that will make most decisions, and then some other decisions are brought to the whole entire quorum of members. Okay, small business resources. I was saying earlier that there's a lot of resources that are currently open to small businesses, especially coming out of COVID. The government has found it necessary to really put a lot of investment there. Small businesses employ the greatest amount of people, and I believe the number is 98%. People are employed by small businesses. If these resources are available at all levels of government, for example, there's a Chamber of Commerce, which is a great resource for any business who wants to develop a business plan or who wants to keep abreast of whatever regulations might be affecting your business. The Chamber of Commerce is very good at that. The BDC is a really great resource when it comes to loans and grants. Innovation, science, and economic development also is in that pool for grants and loans. And there's other associations, pardon me? Someone else. All right, bear with me. Okay. Right, so there's other associations as well, ones that should be very familiar to us. Federation of African Canadian Economics, they also partner with BDC to identify businesses that would, Black businesses, African Canadian businesses that would benefit from grants and loans and so on. They partner with them every year, and I believe they have a budget that's ongoing now. I'm not too sure of the number, so I don't want to try to quote it, of how much money they want to lend Black businesses by 2030. There's also the Canadian Association of Women Executives and Entrepreneurs, the Canadian Federation of Independent Businesses, and Enterprise Toronto. There's, first of all, this is just a very small list. There is a huge number of associations that are devoted to providing small businesses with the resources that they need. And this is not just money and not just loans. This is resources like how to make a business plan. Where do I go, depending on the nature and the structure of my business, to obtain capital, for example. And banks and financial institutions, I was mentioning earlier, TD and RBC are the leaders, I think, currently for business solutions specifically geared at Black small business owners. And Desjardins has a Good Spark grant for businesses as well that they have annually that you can apply for. And if you do meet the requirements, then you'll get a portion of whatever grant they have delineated, pardon me, for the current year.
And earlier you did mention TD has a program too?
Yes.
So
they have a small business solution center. Right.
For
Black businesses. Right, so they have a whole slew of products and services that they offer.
Now, this is, and I heard somebody in the group said they had a business and they just couldn't, they disregarded it because it's just, they couldn't bother with it.
What are the fears?
Yeah, that's what I'm saying. Like, the thing about it is, because we're speaking of generational wealth, we know that having a business as Black people in our community, it will help to build generational wealth. We're not saying, yes, go out and do the business, but do your research. If it's something that you were passionate about, try to find that passion again. Try to figure out what was the hurdle that kept you from doing so. And initiate it again, because what we're saying is with our seminar, we are saying if you'd like to leave the next generation with something, a business is a very good asset to do so.
Yeah, it is most
Mhm.
definitely a very good asset to do so,
Mhm.
especially because you would have started it and seen it through this rough edges, rough stages. There very rarely are there businesses that are profitable within the first 2 to 3 years of their inception. And that is because you're doing things called building something up from the ground up, and you're doing that in continually changing times and circumstances. If you were a business owner who had an excellent idea pre-COVID, you might not have seen that through fruition because COVID was a very difficult time for business owners and businesses generally, employers generally. But if you failed then, that doesn't necessarily mean that your idea was not a good idea. It just perhaps meant that the circumstances were not ones that supported it at that time, or perhaps you needed to seek more capital to keep it afloat, through the difficult times. And there are resources, again, just like there are financial planners when you're sitting down and try to make a decision about how it is that I'm going to save towards retirement or save towards whatever goal it is that you've identified. There are businesses who can sit down with you and take a look at what you desire and project for you a plan that you can execute. And if you would just stick to it throughout the difficult times that you will inevitably have, it's almost like I'm saying to you that you are guaranteed to not succeed within the first 2 to 3 years. So if you don't, that's not an indication that what you have is a poor idea. It's not an indication that what you have is not something that is worthy to continue to invest in. Your generations will benefit. Thank you, Wayna. Our generation, our next generation, pardon me, will benefit from the efforts that you would have put in place when you first established the business before it is that you were ready to move out of it. I know of one business that I'm thinking of right now, very well established, has been around for a very long time, but it was I would describe it as a sole proprietorship in its inception, and it later became a corporation because there were more persons that were on board, and it would support corporate incorporation, for example, at this time where there are more directors to share in the responsibility as well as the burdens. But the difficulty now is most of the directors are at the age of or past the age of retirement, and there is no one to leave that business to. And that business would have gone through all of the rough stages and is highly profitable now and has an excellent model that could be followed. And that's something that is real wealth that you can now pass on to the next generation. And it forms a part of your estate. And that's something I don't think people really consider, that your business is a part of your estate and ought to be dealt with in your estate plan as well.
It also teaches you ethics. It also teaches you, I can see you see your son or your daughter see you passionate about something. And then you decide, okay, you know what? I'm going to proceed with this. I'm going to keep doing it. I'm going to make sure that I set that example for them. They're not going to take what you leave for granted. I'm not saying that kids won't come up and decide what they want to do, but believe you me, if it's planted in them, they will have something of it that is tangible for the future.
Most definitely. That's a lesson that's well cemented
Yeah.
and well exemplified, because they have seen you in that space.
They see you in that space and they see the possibilities of what you have done with nothing. So I will encourage that person to, pursue it.
Last we were discussing the benefits also of small businesses, and one of those big things is the freedom of it. It's literally the freedom of it, and there's going to be responsibilities with freedom as well. So there is a freedom to make your own decision about how you want to earn your own income, when, how much you will invest, who you will employ, how much work you're going to put into it, for example. So it is a huge responsibility, but it's one that we agree is worth it, and it's one that I'm saying is ripe. Now is a ripe time, to the perfect time or a really good time to engage a business and a business plan if you are so minded, because you'll have the resources and the support to see it past year 2 and 3, where you can actually realize some profit.
I don't know about you, Anika, but when we just came to Canada, my dad has 2 jobs.
Right.
Can you imagine if he had one job and was putting that energy into something that he owns?
Yeah.
So you know
Yeah.
what I'm saying? So what I'm saying is that
It's a difference between renting
yes,
and owning.
you understand? So
It
although they did choose a lot of different things that we didn't we would not do today.
Yeah.
The fact of the matter is I learned from them.
Yeah.
And you know what I'm saying? You learn from that. So that's why the next generation needs to see that kind of energy. Not to
Yeah.
take another job for somebody else, or you know what I'm saying? Because eventually you have nothing after you leave that job.
Yeah. Okay. Just to jump back on because we are running over
Yeah,
time.
we're going over time.
So some examples of some Black entrepreneurship programs that are available by the government. One specifically is the Canada Digital Adoption Program. I can send more information on that. I will send more information on all of these funds afterwards. And the Indigenous Growth Fund, Women Entrepreneurship Strategy as well. There's some non-government grants as well that's being offered by Visa. Visa, she's next. Grant and MasterCard's got the COVID relief. I believe that's still active. I'm going to check on that. Futurepreneur and Northern Development Initiative Trust, all of these support Black businesses. And there are some tips for when you're applying for a small business grant, right? Most of them are different, but there are some general tips that you can follow that basically make it a lot more, your proposal a lot more attractive. Right, so you want to gather the following information to help you prepare. Your general application preparation should look like a business description. You can keep it very simple, and it's not really a marketing tool, so it's not something that you'd have to try to sell anyone on your business. You just want to describe the frame of your business, how many employees you have, that's also relevant. You want to have the last 3 years of financial statements, or as many as you have up until the life of the business, and your incorporation documents. You want a project description, right? And this is where the detail comes in when you're trying to fund a specific project. You want to be able to demonstrate in numbers and with data how you plan to grow your business realistically. In the first year, this is how much I expect to make or to lose year 2, year 3, for example. And then show also as the project develops, what you would like to add on to the project. Are you going to work more towards marketing now, or is there a development stage or research stage of your project? Detailed breakdown of expected expenses, any potential risks that you might anticipate, and any economic benefits that it might have for the wider population. So just not just you and your business, but are you able to invest into communities? Are you able to hire from a particular group that might be recognized as underprivileged? It's basically kind of packages your proposal in a way that makes it attractive to certain government programs who might be focusing on a certain community, for example, or a certain group of people, for example.
Now, these researches are so easy nowadays too. Please keep in mind, Google search, a lot of the time we take those little things for granted, Anika.
Mhm.
You know, just Google search it. I know that it will start something. If you're looking to say, okay, you know what, I want to make this bigger. I'm going to see how many people has made the mistakes. It's okay, because you know what? You have the resources at the tip of your hand. It's not just to just go on to and said we're going to TikTok and take a look at that. We can go into place that Google search is amazing.
Yeah.
We got different tools on the internet that can help us with our research. So we as a community needs to take advantage of what we have, because if we do not take advantage of what we have, we will start something and then get this frustrated because we see somebody else out there. They just Google search it and then they start doing their investigation and then they, you know what I'm saying?
And
So
yeah,
it's just
and it
simple looking it up.
It is definitely going out there to try to source
Yeah.
the information where it's at.
Mhm.
Another really good one is to become members of an association in your community that's like-minded as well, because then they'll have they're the ones that the information gets to first.
Find Zoom sessions like these. because we're doing.
So you do, it is
Yeah.
beneficial to
Yeah.
enroll in a lot of associations that will keep abreast of all of the programs that are happening around. They're kind of like the hub for a lot of these things, and they are very resourceful, and they are actually wanting to help, whether we know that they're out there or not.
Yeah.
Okay, we're at 7:23. Let's see if I can finish in 5 minutes. So we just wanted to wrap up estate plan. If I could just show an infographic of what it's like, then we could just go right through it. So an estate plan looks like an accumulation of everything that we've been talking about, right? The first thing that you want to do is to sit down and take a look at your situation and evaluate your assets, evaluate your financial position, right? And then you want to consider projecting where you want to be, right? So with where I am now, where do I want to be when I'm retiring, or what, even determine your age of retirement. It's not mandatory to retire at 65. You can retire at 55. You can retire at 70. So it's completely flexible and it's completely up to you. So after you take a look at your assets, and anytime, after you take a look at your assets, after you take a look at your financial position, you do want to go and speak to some of the professionals. It would be a good time to engage a financial planner. If you have assets that you are looking towards passing on to the next generation, I would highly recommend that the only person that you need to be seeking is a financial planner, not your wife, not your cousin, not your friend who has an insurance plan or might have a financial plan or has an investment portfolio with RBC Dominion Investments. Not necessarily those. You do want to seek, I think at this point, seek out the professionals. It comes at a cost. All good help comes at a cost, and all good help will save you money in the end, right? And because at this point now, your financial advisor is able to tell you about asset protection, asset conservation, and asset distribution. That's something that you can sit down and you can plan. When you start talking about asset distribution, that it brings you to the next phase, which is your estate planning tools. Do I want to distribute my assets in a will? Do I want to create a living trust? Do I want to create a testamentary trust? Do I have a business continuation plan? What does that look like for me? Am I trying to pass this business on to my next generation? Do I need to engage a trust company to manage that business, to employ employees and put them in the right place and put them in decision-making positions to preserve the wealth that is in that business for the benefit of my children? Because we know not every child wants to follow in your footsteps. Not every child would want to be a business owner. Maybe they just want to be an employee. Maybe they want to get into a different field, right? So a good business continuation plan is necessary.
What you can do to leave something. You want to
continue
that well.
That well.
You understand? So what we have been doing for the past 3-4 weeks, we have been informing you on what is out there. We have been giving you the information so that you have the tools to make decisions. We're giving you the information so that you understand that you're not alone. You're not in a box. You can start it today. Right, as simple as writing a will can start today. You don't have to have a whole bunch of money. Just sit down and say, you know what? I am going to have the conversation with my significant other, and I'm going to do something about my position where I'm at. I'm going to evaluate. I'm going to start saving. Whatever you start to do today is what we've been trying to get you to this point from the beginning of our seminar.
Yeah, most definitely. I think the important thing to drill home is that situations do befall us, death being a definite one, sickness being a definite one that we've come to see. The time to consider estate planning is not the time when you have an estate per se, or the time when your death is in numbers upon your older age, for example. The time to consider an estate plan is now, from where you're at to where you want to be. Many of us have dependents, and we fail to consider that it's not just to save for their education is our requirement. At any time, we might not be able to work. At any time, some of our dependents might become disabled themselves. So it's always very good to have to contemplate these things and contemplate them from a position where you feel empowered, so that you can have the conversation and can go out there and seek out the tools that you'll need. The final aspect of the estate planning tools would be life insurance, funny enough.
Yeah.
There's a means to create funds through life insurance. There was a life insurance plan that I wanted to talk about as well. One that once you do achieve a certain age, it becomes almost like a reverse mortgage where it pays back out to you without diminishing the amount that's left for beneficiaries. I'm not too sure how that one works, but it did slip my mind. But I look into that as well. So it is possible to generate funds through a life insurance
Sounds like
before
we have a next
your death.
seminar next month, Anika.
Okay. All right, I'm gonna stop sharing my
All right.
screen and just wrap up. Okay, so thanks again, you guys. Thanks for staying on. We are about half an hour over the time. Want you to just to look out in the month of December, we're going to be putting together some podcasts that will dive a lot deeper into some specific aspects of the subjects that we've been addressing this past month. I want to encourage anyone who has questions to please reach out and let us know if there's something that you wanted us to look into a little bit more so we could discuss it for your benefit. We do want to keep the conversation going, and we want you a part of that conversation. We want you to extend the conversation to the wider community, to your family, and to your friends. It almost sounds like I'm wanting to indoctrinate you, but I don't have a problem with saying that I want to secure wealth in my community. I do want to change the face of the examples and the mentors that we have for ourselves and for our future generation. And yeah, let's continue the conversation.